Hello homeowners and aspiring homeowners. I'm Tim Hill, your go-to mortgage broker here in the Lower Mainland. If you're thinking about buying a home in Vancouver, Surrey, Burnaby, or anywhere around here, you've probably heard a lot about interest rates lately. But what do they really mean for you? With rates at their lowest in years, under 4% in some cases, there's a lot to unpack. In this video, I'm breaking down interest rates from A to Z, how they affect your mortgage, and what you need to know to make smart moves in our pricey market. Stick around for my top 3 tips to save thousands. Let's dive in. So, what's an interest rate? Simple. It's the cost of borrowing money to buy your home. When you get a mortgage, the lender charges you interest, usually as a percentage of your loan. Right now, in July 2025, the Bank of Canada's key rate is down to 3.25% after cuts totaling 2% over the past year. That's why mortgage rates are looking good. Close to 4% for a 3-year fixed, or about 4.6% for a 5-year fixed, depending on your lender. Why does this matter? In the Lower Mainland, where the average home price is $1.2 million, even a 0.5% rate change can mean hundreds of dollars more or less on your monthly payment. For an $800,000 mortgage, dropping from 4.6% to 3.79% saves you about $350 a month. That's $4,200 a year, enough for a nice vacation or a chunk of your property taxes. But rates don't just affect your wallet, they shape the whole housing market, from how much you can borrow to whether prices go up or down. Let's get into the nuts and bolts. When you get a mortgage, you've got 2 main choices: fixed or variable rates. A fixed rate, like that 3.79% for 3 years, stays the same, so your payments are predictable. Great for budgeting, especially in a place like Vancouver, where home prices are already a stretch. Variable rates, tied to the Bank of Canada's rate, are lower, say 3% right now, but they can rise or fall. If rates drop again, you save. If they climb, your payments could jump. Here's a real-world example. For a $1 million home in Burnaby with 20% down, your $800,000 mortgage at 3.79% fixed over 25 years means monthly payments of about $4,200. Go variable at 3%, and it's closer to $3,800. But if rates rise to 4%, you're back near $4,100. As a broker, I'd say fixed is safer if you're risk averse. Variable's a gamble that could pay off if rates keep falling. Then there's the stress test. Even with low rates, Ottawa makes you qualify at a higher rate, around 5.79% today, to ensure you can handle hikes. That limits how much you can borrow, especially with Lower Mainland prices. A family earning $150,000 might qualify for a $900,000 mortgage at 3.79%, but only $750,000 under the stress test. That's the difference between a detached home in Surrey or a condo in Coquitlam. Now, let's talk about the bigger picture. How rates move the Lower Mainland housing market. We're in a buyer's market right now, with 12,744 homes listed in June 2025, up 32% from last year. The benchmark price is $1.7 million, down 1.1% from 2024. Low rates close to the 4% mark are bringing buyers back. Sales were up 12% year over year in June. When rates drop, more people can afford to borrow, so demand spikes. That's why condos in East Vancouver, averaging $750,000, are seeing more offers. But it's a double-edged sword. Higher demand can push prices up, especially for detached homes. which are still $2.1 million on average in Greater Vancouver. If rates stay low, I'd bet on a 3 to 5% price bump by 2026, especially in hotspots like Burnaby or Richmond. But what if rates rise? Say the Bank of Canada hikes to fight inflation, maybe from US tariffs, which could shave 1 to 5% off BC's economy. Higher rates mean fewer buyers, which could cool prices. Back in 2022, when rates hit 5.5%, sales in Vancouver dropped 30%. As a broker, I'm watching the bank's next moves closely. It's a balancing act. Rates don't exist in a vacuum. Let's talk wildcards. First, the US. With higher US tariffs on Canadian goods still a real possibility, our economy could take a hit. $69 billion by 2028, some say. The Bank of Canada might cut rates further, maybe below 3%, to soften the blow. That'd drop variable mortgages by a corresponding amount, a win for borrowers. But a weaker economy could scare off buyers, stalling our market. Then there's federal policy, 30-year amortizations for new builds, and the increased $1.5 million insured mortgage cap help first-timers. But they also boost demand, keeping prices high. Immigration cuts, study permits down 35% from 2023, mean fewer renters, which could push condo investors to sell, adding supply. As your broker, I'm tracking these to help you time your move. So, what's the takeaway for lower mainland buyers? Interest rates are your biggest lever in this market. They decide what you can afford, how much you pay, and where prices are headed. Here are my 3 tips to win. First, shop rates now. With 3.79% fixed or 3% variable, lock in or get pre-approved before rates shift. I can hunt down the best deal for you. Second, fixed or variable. Know your vibe. If you love certainty, go fixed. If you can handle some risk, variable might save you thousands. Third, plan for the stress test. Get your finances in order. Cut debt, boost savings, so you qualify for more, even in Vancouver's pricey market. I'm here to make this easy. Drop a comment. Are you buying soon or waiting for rates to drop? Reach out at your email phone or subscribe for more lower mainland market tips. Let's get you into your dream home, Vancouver. See you next time.